morning, hello and welcome to Moneycontrol's live stream. You're tuned into a fresh new edition of Opening Bell with me, Lovisha Darad. Well, we are back with a fresh day and it's the final day of the trading week. And today the GIFT Nifty is hinting at another quiet start for the markets. But after the large quantum of the fall that we saw yesterday, we are hoping for some relief in today's trading session. If you look at the global screen, US markets very quiet. Traders are still worried about the rising bond yields. The 30-year and 10-year bond yields, they did see some cool off overnight, but that too was quite minor for anything to assess going ahead. But Asia Pacific markets, that was largely higher. Japan did well even after their core inflation numbers rose for the month of April. So yes, the rising deficit worry on the Trump's new tax bill is what is keeping the overall sentiment quite muted also. But how much worry that will be for India is something we'll keep an eye out for, and we'll talk about this with our experts as well. And like usual, we'll also have some results reaction coming in. ITC, Grasim, Sun Pharma, all of them reacting to its Q4 results today. Also, we'll take up your stock related queries, so keep posting them on our live feed and we'll take them up with our market experts. First up, let's quickly take a look at the top headlines this hour. US equities ended flat as investors worried about higher yields and ballooning fiscal deficit hitting the economy. The 30-year yields sheds after hitting the highest since October 2023 after the House tax bill. Stocks in the Asia Pacific largely rise as investors assess a slew of economic data. Meanwhile, the GIFT Nifty hints at a mildly positive start for the Indian markets. Oil prices slip, weighed down by stronger dollar and the possibility of OPEC increased production. Gold prices also fall as investors booked profits after it hit two-week high. ITC reports a mixed set of numbers where revenue beats estimate while cigarette volume growth comes in line with what the street was estimating. Sun Pharma reports an operationally in-line quarter, but the management commentary could weigh in. And President Donald Trump standoff with Harvard University escalates as the administration blocks from enrolling foreign students. Existing students are being forced to transfer to another school or lose their legal status. Right, as I was talking about, in yesterday's trading session, we did see that Nifty ended with a 204 points loss. In the last 30 minutes or so, 1 hour or so, we saw that the Nifty saw a little bit of a recovery, but still ended with about losses as well. If we look at the Midcap and Smallcap, all of them, they were down. It was a broad-based rout as well, and 41 out of 50 Nifty constituents ended in the red. If you talk about sector specific, barring Nifty Media, all the sectors ended lower. And if you look at this worst performance of yesterday, that was stood out to be your Nifty FMCG, IT, oil and gas indices. But some of the Q4 results that we'll be tracking out in today's trading session, that is Ashok, Leyland and JSW Steel, that will be reporting their Q4 results later today. But some of the cues that will set the tone of the trade today. First up is your FIIs. They have once again sold stocks which was worth about 5,000 crore rupees in the cash markets. On the other hand, DIIs have bought stocks which was worth about 3,700 rupees in the cash markets in yesterday's trading session. So yes, we saw that the large fall which was led in the markets definitely had to be by the FIIs booking some profits at this point of time. But coming to the next, which is your option cues data, Nifty put call ratio has risen to about 0.94 levels. So that indicates a little bit of optimism in today's market also. We'll watch out if there is any rebound or any relief rally that we can see also. And in the FNO ban list, Dixon Technologies, this has been a new stock which has been added to the FNO ban. And the stock that retain, that is the likes of Manappuram Finance, RBL Bank and Titagarh Rail Systems, all of them continue to be a part of the FNO ban. But yes, just a couple of minutes before we go to the open, 10 minutes to go, but let's take a look at some of the pre-open rates. Sensex down about 60 points, Nifty however up about 24,600 levels. That is where the pre-open may mixed, quiet and a flat start which we are seeing at this point of time. But with that, let's quickly get on board with our technical expert of the show. Joining me is Nirav Chheda of Nirmal Bank. Nirav, good morning. We are seeing bouts of consolidation. Do you expect the trend to continue for some time given the good run-up we saw from mid-April onwards?
Yeah, good morning, Lovisha. At this point, Nifty, after reaching that 25,000 levels,
Hmm.
from sub 22,000 odd, that's a 3,000 point rally.
Hmm.
So definitely, after such a big rally, some consolidation had to come in, which it has. But still, the month of May has been really good. Expect 24 450 or 24 500 to be a very good support area for Nifty. And from here on, probably some consolidation for the next couple of days, and then you will see another bout of buying, which can probably take Nifty above the 25 500 levels as well. So as of now, for today, don't expect much. I believe some consolidation should be there. With 24 500 being a very good support area. So if Nifty does come there, I would expect Nifty to bounce back from those levels, and that is where you look to buy Nifty with a stop loss of 24 400 odd. These are future levels. Looking at Bank Nifty, see this has come down from 55 500 levels. It has gone into consolidation. It is making a flag kind of a formation now. It will take another couple of weeks for this formation to take shape. And some of the banks are also showing signs of some short built up. So I'll be staying clear of Bank Nifty at this point of time. See, this has been the stronger of the two indices, and now is the time where consolidation will come in this index. Probably some selling as well. So it is better to stay clear until that 55 500 level is broken above again. Until then, stay clear. Do not look to buy Bank Nifty at this point of time.
Okay, do not look to buy Bank Nifty at this point of time. Nirav, what about the Nifty IT and Pharma Index? Because we did see some concerns of slowdown in US past few trading sessions. So, is it time to stay away from the export-oriented themes at this point of time?
Not really. See, basically, yes, Nifty IT probably I can agree with that. But for
Hmm.
pharma, I believe there are pockets where you will see some buying coming in. This had been in consolidation for quite some time, and it is just breaking out. So the likes of DVs, even a smaller stock like a Gland, they look very good at this point of time. So there are pockets where you can look to buy, stocks in the pharma pack. But yes, in the IT pack, most of the stocks are in a lower top, lower bottom zone. They've reached their resistance, and likely, in all likelihood, they will probably come down. So yeah, look to buy pharma, but you can stay away from IT.
Okay, stay away from IT. That is the word coming in. What about the defense theme, Nirav? Because we did see some profit booking for 2 days, but after that, 3 days of consecutive rally. That is what we have seen for the defense stocks, despite the valuation concern. Does the chart still look strong going ahead?
Oh yes, if you see, some of the defense packs, something like a BEL, it was in a long consolidation and it broke out about 300 in 2 weeks from 300. It has gone to 380 odd. So yeah, I mean, there are stocks which are doing very well, and looking at the overall theme, it looks like defense is going to go up from here. The best pick probably in this space will be HAL and Cochin, which have both broken out, and there's a good likelihood that both these stocks will do well going forward. You can continue to buy and dip in this whole sector. I believe in the next month or so this will outperform still.
Okay, okay. What about the Nifty Auto Index, Nirav? Do you believe that the it was one of the worst sectoral performer yesterday? But from April lows, the stock, the index has done quite well with about 14% uptake. How does the charts look like going ahead?
See, auto as a whole doesn't really, excite me much. But still, there are stocks in this pocket which can probably do well. As a pack, it has hit a resistance, and in all likelihood, some consolidation will come in. Having said that, stocks like Bajaj Auto will probably outperform because they've witnessed a breakout, and in all likelihood, there'll be only one or two stocks like Bajaj Auto which will outperform. The rest of the stocks will be in consolidation. So I expect the whole sector to underperform in the next week or so.
Okay, next week or so it can underperform. What about the broader end of the markets, Nirav? Because that was holding the fort for the markets, in the on the upside. But right now, even that is not performing well. Do you believe that the valuations, that does the chart indicate a little bit of an overbought condition at this point of time, and that's why we are seeing a fizzle out of the rally?
If you're saying, this about mid cap and small cap, then I can agree. Yes, it is just showing some sort of fizzling out of the rally, but large caps are still here to stay. See, what has happened is the leadership has actually changed from small cap, mid caps to large caps. And in large caps, you're seeing, most of the stocks, something like a Reliance taking up leadership and going up. So I believe buying will start to come in. Also, when you see so much happening globally, generally the risk of thing happens is that large caps attract a lot of money. And that is what is happening. I believe they've just started their rally. A high top, higher bottom formation is set up for most of the stocks. And they should outperform the small cap, mid caps. But for small cap and mid cap, this is a speed bump. Probably, for a week or two, they will underperform. And largely, for the next few days, if you want to do some trading, put up money only in the large caps.
Okay, just put up money in the large caps. So is that what is the trading strategy to go about going ahead as well, Nirav? Because right now everybody is considering that it's a buy on dips market despite what the consolidation has been. So would you also recommend the same, that it's a buy on dip strategy for this time?
Yeah, I mean, that really works, at least in the Indian markets for quite some time. And yes, I would agree to that. Buy and dip, again, this term is something one needs to understand on how that works. So if the dip comes for a week or so, it is fine. But if that dip, continues for the next 2 months, it becomes very difficult to buy the dip. So, I mean, at this point, buy the dip. But once that reversal comes in, that is when I look to buy, and that is a much better strategy at this point of time. So yes, large caps will be my focus, and probably the stocks that I would pick for today or for the next couple of days. Yes, that would be large cap, but I'll go into the metals pack. Something like a sale, which looks very good to me, because metals have seen short covering action in the last 2-3 weeks, and they are strong into the buying zone. So expect metals to do well. So sale at this price looks very good. You can look to buy this stock. 118 should be the stop loss, and probably the stock can go up towards 140 odd. If you want to buy something on a reversal, something like a buy on dip kind of a thing, then Tata Technologies is something that I'm looking at. It has had a huge dip from sub 1400 odd levels, up to the 600, but a good reversal is in place, and volumes have been terrific. So, something like a Tata Technology can be bought at current levels with a 750 odd stop loss and about 800 odd target.
Okay, all right, all right. Tata Technologies, that is where you're bullish on at this point of time. But yes, the first trades coming on your screen, we have opened mildly in the positive territory. But yes, above that 24,600 mark, that is where Nifty is hovering around. Sensex, however, flat in the red. So yes, it's a quiet start for the markets, like we were talking about that. The GIFT Nifty was also indicating, and so did the pre-open rates. And yes, we have opened, mildly in the positive territory. If you look at some of the sectoral indices, Nifty Auto Index yesterday was one of the worst sectoral performers. Today it has seen a little bit of a pullback with about 0.3% gains. Bank Nifty Index mildly in the positive territory. Nifty IT Index with about 0.1% gains, given that yesterday that was also one of the worst sectoral performance due to concerns of slowdown in the US economy. Nifty Pharma Index, however, seeing a larger cut of about 0.9%, which is nearly a percent or so, given that Sun Pharma earnings was not something that they were impressed by, and the management commentary does indicate that the higher spending that they plan to do in FY26 is expected to weigh on the margins going ahead. So yes, We'll watch out on that also. Other than that, Nifty Metal Index, as Nirav was talking about, with about 0.1% gains, we can see at this point of time, Nifty Metal stocks are doing quite well. If we look at the others, like for instance, Nifty Realty Index, mildly in the positive territory. But on the broader end of the markets, mid caps flat in the red, small caps also flat. So both of them are flat at this point of time. Let's take a look at some of the top gainers and losers on the Nifty 50. Top gainers continue to be Grasim with about 1.6% gains, reacting positively to its Q4 set of numbers. Trent with about 1.6% gains, given that we did have a news flow saying that Trent is expected to replace FMCG major Nestle in a sensex reject, which is expected to remain effective from June 23 onwards. So yes, we can see some good reaction coming in on Trent also. ITC with about 1.3% gains on its Q4 results. Bharat Electronics extending its gains with about 0.9%. So Adani Ports also seeing a gain of about 0.8%. On the other hand, the top loser, Sun Pharma, I was talking about, and it is seeing that the sentiment is quite weak with about 3% cut coming in on Sun Pharma. ONGC also not doing well with about 0.3% cut. Yesterday also we can see it's an extension of the downtrend that we can see on ONGC, not reacting good to its Q4 set of numbers. Hindalco with about 0.3% cut. Cipla, Titan, Dr. Reddy's, they continue to be on the top Nifty 50 losers list. But yes, Trent, one of the top gainers on the Nifty 50, we can see that the Sensex reject is expected to take place and Trent is expected to replace Nestle. On the other hand, Bharat Electronics is also doing well because it is expected to oust IndusInd Bank from Sensex, and the reject will be effective from June 23 onwards. Nirav, what do you make sense of the stocks as exiting from the index? Because definitely we can see that the street is cheering the entry of Bharat Electronics and Trent into Sensex.
See, I don't know what to make out of it. Yes, there will be some flows which will be out of the system for some of the stocks which are going out, something like an indices. But inversely, if you see, the overhang in this stock is over. Whatever negative was to come has come in. Technically, if you see, this stock has fallen from 1600 levels, your lower top, lower bottom formation, and there are some huge candles where, in a week it has fallen more than 25-30%. Now the volumes are there for this stock to outperform. So I believe, in fact, now you should be looking to buy this stock from a near and a medium term perspective, because I believe the support has come in for this stock, and I don't think this will go below that 735, 740 odd levels. In fact, it should outperform the other banks from current levels. It can go up towards 900 odd levels going forward. So yeah, I would suggest to buy IndusInd with a strict stop loss of around 740, or it would be a good thing for this stock to go out of Sensex, I believe.
Okay, all right. Let's take one stock in focus, which is your ITC. The stock is reacting well to its Q4 results. We saw that the profit grew multifold on a year-on-year basis, definitely driven by one-time exceptional gains. Our revenue also rose by about 10% year-on-year. If you look at segment-wise, the FMCG cigarettes business, that revenue was up about 6.2%. Profit on the cigarette business grew about 5%. Agri-business revenue also did well. And the profit also did well. However, the paper and packaging revenue, profit, that slipped by about 33% on a year-on-year basis. The brokerages have largely remained bullish on the counter, but they remain cautious on the paper business because that continues to face extreme cost pressure, and they expect that it is likely to take a few quarters to ease going ahead. Goldman Sachs have given out a buy call on the counter, HSBC has given out a buy call on the counter, and CLSA have also stuck with an outperform call. Nirav, if you look at the stock has been underperformer so far this year, but what does the chart indicate going ahead right now?
See, chart is in consolidation. The stock is in consolidation. I believe nothing much will happen in this stock for the next couple of weeks at least. On the upside, 450 is a resistance zone, and on the downside, about 400 is a support zone. It is oscillating in between these two zones in the last 3-4 months, and I believe that will continue for the next few days as well. So I don't see a trade in the stock at this point of time.
Okay, all right. Let's take another stock in focus. That is your Grasim Industries, because that stock is also doing quite well. 2% uptick that is coming in on Grasim. Given that we did see, it's reacting well to its Q4 performance. We did see that the profit grew about 9% year on year, and the revenue has risen by about 17% year on year. Nirav, given that crude prices are also stable, does this mean that we can see that the stock's uptrend going ahead?
See, Grasim has hit its all-time highs, near its all-time highs around 2870 odd levels. And once that breaks, this stock is slated to move up higher, much higher as well. But I would only suggest if you're looking to buy this stock, buy it only about 2870 levels on a closing basis. Because if it doesn't cross this level, that means a double top formation would be in place, and once the stock breaks the 2400 levels, it would be in for a huge sell-off as well. So it's at a critical juncture. So I would just suggest to wait on till that breakout comes in and buy above that breakout levels.
Okay, all right. Let's take some viewer queries that has dropped on our live feed. The first query coming in from Naveen, he's asking the view on Uno Minda. Uno Minda on the charts, if you look at from 1 month perspective, good run up, but Q4 performance was quite disappointing. We did see that the profit declined by about 4% on year basis, and even the consolidated revenue from operations, that however saw a good increase on a year basis. But from a near-term perspective, Nirav, what do you expect for Uno Minda?
See, near term, a small flag breakout has come in. Also, consolidation breakout above 990. I believe this stock can move up from current levels, and it can reach about 1120, 1130 odd levels. So you can look to buy this stock at current levels. 980 will be your stop loss.
Okay, 980 is the stop loss for Uno Minda. Let's take another viewer query. Naveen is also asking the view on Garden Reach. I know that you're quite bullish on defense theme as well, Nirav, and you believe that the stocks are quite good. So what is your target levels that you want to highlight for Garden Reach?
When from 2023 onwards, most of the stocks had seen a circle or a rounding bottom formation, and then broke out, for a big rally. And this is what is happening in this stock. A small and slow rounding formation took shape, and in the last couple of weeks, this stock has shot up and it has given a breakout. So, I believe this stock can move up quite significantly from current levels. One can look to buy the stock at current levels, and on some declines up to 2800 levels. 2750 is your stop loss. I believe the first target that it can go to is 3200.
Okay, 3200, that is what we are watching out for Garden Reach also. Let's take another viewer query. Pooja Khanna is asking that she's holding 250 shares of Varun Beverages at 490 rupees per share. She's asking what's the support to add an average more going ahead. 490, that's where she took at, and right now the stock is trading at 480. So she's at a bit of a loss at this point of time. But what do you think, Nirav? What is this? What do you suggest for her?
See, this stock has witnessed a multi-year rally from 2017 onwards up to 2025 odd. And it has risen hugely from there, more than 20x. After that, consolidation took shape and a breakdown has come in. And that breakdown has been tested as well. And from there, that breakdown had come in at around 570 odd levels. The stock went down to 400, again came up to 570, retested the breakdown, and has fallen since. So this is a classical breakdown formation, and this is not a near-term formation. This is a longer-term formation. So I believe the stock is going to go down further, and the price is very near to where she has bought. It is better to exit the counter right now, because the losses will only widen.
Okay, all right. Better to add right now for Varun Beverages. Let's take another viewer query at this point of time. Rupak is asking the view on Zomato or Swiggy, and he's asking whether one should look to invest in Zomato or Swiggy, and if yes, so which out of the two would you recommend? Any thoughts, Nirav, for both of them, because both of them are exhibiting quite a negative trend from a 6 months perspective.
Yeah. So from a near-term perspective, Swiggy will be a better option. I believe the stock has hit its bottom, from sub 600 levels. This is around the 300 levels. You can keep a stop loss of 290 and go long in this counter. I expect the stock to come up to 365, 370 odd, which is where you look to book profits. Zomato, from a near-term perspective, doesn't look good because it has witnessed a bearish engulfing pattern, which is a negative pattern. Probably it can take this stock lower up to that 200, 205 odd level. So looks a little bit negative at this point of time, but Swiggy is a better option.
Okay, Swiggy is a better option. That's the word coming in. But let's move on. Take another viewer query. Satya is asking if there is anything similar to ITD cementation, because he's holding the share at about 98 rupees. And what is the target for 12 to 18 months? Nirav, any thoughts on this?
Oh, thank you, Satya, for following me for so long. I believe I recommended this at 1995, and I believe he's been, owning this from that time. That's great to hear. One thing is very clear, that something like a Gland Pharma, which is near about the bottom, and it is now beginning its 12 to 18 month long-term uptrend journey. So, one can look to add this stock at current levels. I believe this stock can probably outperform the rest from that 12 to 18 month perspective, and slowly and steadily reach that 2500 to 3000 levels, which is my target.
Okay, all right. Let's move on to another viewer query. Anune Iriki is asking the view on Keynes Technology. How does the stock look like on the charts? Because from 6 months perspective, if we look at from December highs and January highs, the stock is down about 21%, Nirav.
Yeah, see, Keynes, the chart is positive, no doubt about it, but I believe there is a slight negative. It should have broken above the 6400 levels, which it could not. It tried a couple of times, but it could not, and it has come down since. So I will only suggest that once 6400 is broken above, look to add this position, and then ride the trend up to that 7200 levels. But until then, just hold on, don't buy. If you already bought, your stop loss should be around 58.50.
Okay, 58.50 for Keynes Technology stop loss. Let's take another stock in focus, that is your Sun Pharma, because it is one of the top Nifty 50 losers and not reacting well to its Q4 results. We did see that the profit came down by about 19% year on year. On the other hand, revenue rose about by 8.1% on a year on year basis. If you look at what the brokerages are saying, Nomura has given out a neutral rating on the counter, and they believe that the company's guidance for FY26 suggests that the overhead spends would rise ahead of the revenue growth and eventually impact the EBITDA margins in the near term. And they also expect that the FY26 revenue growth, which is pegged at mid to high single digit, is less than what the street was estimating to be about like 10%. That is what they were working with. On the other hand, Goldman Sachs have given out a sell call on the counter, and they have also believed that the adjusted EBITDA margin is ahead of the estimates on account of lower R&D and other costs. Nirav, what is the view on the counter? Today the stock is not performing well.
Even I hold the view that this counter has become a little negative. It is making a flag kind of a formation with an important resistance being at 1830 odd levels. There's a chance this stock can come down further up to 1550, 1560 odd levels. So from current levels, another 100 rupees downside is possible. So yeah, I would not be a buyer at current levels. Probably once 1550 odd comes, that is when I'll take a look again. But until then, not buying it.
Okay, not buying. Well, let's take another viewer query at this point. Arune is also asking that he's taken holding PG Electroplast at 844 rupees, and he's asking whether he should add more or should he shift to Amber Enterprises. Any thoughts on this, Nirav?
Yeah. See, at this point. You look at the share, most of the stocks, which have really risen from the bottom in the last 1 or 2 years, are facing consolidation or are falling, especially in the mid cap and small cap space. So yeah, PG Electro Plus is also one of the counters which is seeing a double top kind of a formation, and this formation isn't very good at this point of time. So yeah, it can probably come down up to the 600, 620 odd levels. It would be a better option to exit the counter. But having said that, looking at the amber chart as well, don't think much upside will come in amber as well. There is a important resistance around 7,000 levels for this stock, and once that is broken above, only then you look to add positions there. Better option would be just exit this and wait for the breakout, or if you want to buy something else, then Gland will be a better option.
Okay, Gland Pharma is a better option at this point of time. Let's take another viewer query. Hemant Singh is asking the views on Titagarh Rail. Titagarh Rail, any thoughts on the counter, Nirav? Because the stock has seen a good run up in the past 1 month, but everyone, the street is quite concerned about the valuations going ahead for not only just Titagarh, but also for the entire railway pack.
See, I don't know much about valuations, but this stock has fallen, from 1800 odd levels up to 800. That's more than a 50% fall. So for me, it is a good time to add positions. There's a good reversal, and the volumes are there on the reversal. So means someone strong is buying. So that is a good thing. I would be a buyer in Titagarh at this point of time. Even on some dips, I would be a buyer. You can keep a stop loss of around 850 for your longs and expect 1050 as your target.
Okay, all right. Let's take one more buzzing at this point of time, which is your Ramco Cements. The stock is down today, not reacting well to its Q4 results. We did see that the net profit has declined by about 74% on a year-on-year basis, and revenue has also slid by about 11% on a year-on-year basis. But the stock is up 23% from March lows. Today, the stock is not reacting well given its tepid Q4 results. But what is the view on the counter, Nirav, for you, Ramco Cements?
See, this is in consolidation, and it has tried quite hard to break above 1020 levels, which it has not been able to. This is the third attempt in the last 6 months, and if it does break above this level and close above the same, only then look to buy. At this point of time, just wait and watch. Do not buy this counter at this point. Only on breakouts you should be buying.
Okay, only on breakouts you should be buying for Ramco Cements. All right, just one last question before we let you go. Anything that you're finding value at this point of time, and what are your top picks at this hour, Nirav?
So, top picks would be SAIL. I believe this stock can, really perform well from current levels. 118 will be the stop loss, and I believe 140 can be the target. The second one, again, is Tata Technologies, and this is one stock which has seen a very good reversal, and I believe this stock can move up from current levels. Your stop loss can be around 750 odd, and 800 would be your target.
Okay, Tata Technologies and SAIL, that is what we need to watch out for. But with that, we have to let you go, Nirav. Thank you so much for your time and answering our viewer queries.
Thank you.
All right, let's take a quick check of the markets before we move on to our next guest of the show. If we see, the markets have recovered very smartly, and right now we are trading and in the positive, in a good positive territory. Sensex is up about 370 points. Nifty is also above that 24,700 mark. So yes, we did start in the green, and now we have extended the buying also in today's trade. We were hoping for some relief rally, and that is what the resultant impact is for today's market. All of the sectors are trading with with good gains. Nifty Pharma Index is the only one which is trading with about 0.5% cut, given that Sun Pharma results in the management commentaries weighing on the sentiment. If you look at the mid-cap and small-cap indices, that have also exhibited quite the resilience. Small caps with about 0.4% gains, mid caps also with about 0.4% gain. So yes, all in all, a good market at this point of time, but we'll hope that the sustenance and the extension of this buying is key for an extension of the rally as well. But moving on to the next guest of the show, we have Nirav Karkera, Head of Research at Fisdom, joining us. Nirav, how are you viewing the markets at this point? We are expecting trade deal with US soon, and earnings have also reached almost an end.
Hi Lovisha, always a pleasure chatting. So the way markets have been acting up over the past quarter, it also led to a few good things. The entire shakeup ensured that there are more pockets of value that are created. In fact, at a broader aggregate level, valuations may be slightly concerning, but the entire bout of volatility and the route that was created in the past quarter has created rooms and pockets of opportunities where even valuation seems to be fairly justified, especially from a growth standpoint, going ahead. Talking about the earnings season, it has been a mixed bag. I feel so far, it is not something worth enough to write home about. But having said that, the outlook is pretty optimistic and upbeat. And the earnings season comes on the back of several iterative downgrades over the past couple of quarters. And from here on, there is good reason to believe that this will plateau from here on, and the scope for upside surprises increase as we move ahead. So FY26, we believe there will be early signs and green shoots of revival in earnings. And having said that, one can expect markets to also pencil it in more aggressively, especially drawing more confidence against the easier macro situation going ahead.
Okay, okay. But Nirav, given the kind of earnings we've had, do you expect this rally to be sustainable until and unless we see a good earnings growth going ahead from FY26?
So going ahead, of course, the valuations and the buying interest is going to be largely dependent on the earnings. But at the same time, flows and sentiment will also play a very key role. Of course, the expectations are that earnings are going to recover and revive in FY26. Having said that, the FII interest into India, especially EM only funds and long only funds into India, against the backdrop and context of whatever's happening in the US and other emerging market peers, positions India in a sweet spot. Of course, versus historical measures, the valuations may still not seem very easily palatable, but flows will determine. Surprises to the upside, especially going forward. So earnings will form the bedrock, but I feel flows and investor confidence, both of these vectors are also pointing towards the upside going ahead in the next couple of quarters.
Okay, okay, Nirav. Nirav, what about the rising bond yields? How much of an impact do you see for the Indian markets as well going ahead? Because so far experts are saying that I spoke to that it's going to be a short-lived reaction. It's just a temporary thing, and India is also going to brush aside through that. But the U.S. markets were quite overnight, and there is a little bit of a concern that is coming in from the debt markets also. But how do you pencil in at this point of time?
So there is a fair amount of truth into whatever you said. Our expectations are largely aligned. It is going to be a short-lived reaction. In fact, I would go to the extent to say that the reaction could be muted as well in terms of quantum. And there are a couple of reasons, right? So the bond route that we're talking about largely emanates from the Japanese bonds as well as the US Treasury bonds, right? Both of them saw very weak demand over the past auctions. In fact, the Japanese bond auction hasn't seen such a dismal response since almost 12 years now, at least. And the demand for the US Treasury auctions has been the lowest since February. So, of course, there are inflationary pressures and federal deficit expectations that are weighing in heavy on the bonds. Of course, the Japanese route could lead to a lot of hardening on the US bond side as well, considering the relatively significant Japanese ownership of US treasuries. And at the same time, the entire tax bill that is underway is expected to add to the current debt bill that US is already servicing. So it is estimated that it would add another 4 trillion odd dollars to the 36 odd trillion. Now it is not just the debt figure that is worrisome, but the entire debt servicing cost that comes along with it, right? So there are concerns, and this comes against the backdrop of inflation. If you look at the earnings outlook and the management commentary of US companies that reported earnings, they're all indicating towards an inflationary environment wherein they are expecting to raise prices on account of the tariffs that have been imposed on the imports, right? So all of this is happening, and at the same time, the spreads between US and India yields continue to narrow. Of course, India versus Japan, the yields still remain lucrative, but the India US yields are narrowing, and which is something that is bearing heavy on Indian bonds. But having said that, the growth outlook of Indian equities kind of partially offset the pressure that the narrowing yield spreads are exerting on the earnings yield right now, right? So, having said that, we believe that going ahead, the growth will be led largely by fundamentals and growth expectations. And as far as the impact of the bond is expected, if you talk about impact of the Japanese bonds on Indian equities, I feel that the impact can be to the extent of yen carry trades being unwinded into India, and that is not a very large percentage. And at the same time, EM specific, country specific, long only funds will remain undeterred in their buying thesis, right? Because of the bond yields that will continue to flow into India. Having said that, a weakening dollar market and sentiments are not going very good for the US amidst the entire credit downgrade. As well, emerging market is once again gaining center stage at global desks, and India remains a very, very strong contender within the impact.
Okay, okay. Nirav, what does this mean for IT stocks then? Because they've seen a good amount of correction this year itself, 15 to 20% correction. Most of the ITs, majors have seen the correction. But with the concerns of fiscal deficit ballooning, US economic slowdown, Moody's downgrade, would you believe that the correction is, and the stocks have already priced in most of the worries, or do you expect more, more downside to come in?
So most of the imminent worries have been effectively priced in. Of course, everything that you spoke about, the credit downgrade, the earnings slowdown, the economic slowdown, the recessionary risks, no matter how remote that the US is facing as we speak, it has all been penciled in. The only point here is the very near-term and imminent effects of such a slowdown has been penciled in. We believe there is still room for second order effects to start being factored into the prices. So it is not as if the prices have bottomed out. In fact, the IT sector is in dire need of a positive trigger to reverse the trend from here on. If not, we can continue to see the sector remain subdued under a lot of pricing pressure.
Okay, okay. Nirav, then what would you suggest investor strategy should be this year? Do you believe that they should conserve money until a reasonable earnings is visible going ahead, or should they, buy on dips in this market?
So, no, while asset allocation is always the basis of any investment strategy and one must stick to it, but for those people who have been thinking about an opportune moment to look at it, I feel now is definitely the time. There are very lucrative opportunities opening up even beyond equities. It's a wonderful time to start looking at fixed income as an asset class, domestic fixed income. One can look at commodities very closely and reallocate a certain portion to that. Within equity, definitely buy the dips, but ensure that the dips are meaningful enough to rationalize the valuation post the dip. Please ensure that you are not falling for any value trap or valuation traps. It is quite characteristic of such times in the cycle to present opportunities that are indeed traps masked as opportunities. So even within equities, be cautious, be highly selective. Bottom up is the way to go. As a at Fisdom Research, we are optimistic on large caps more at this point in time. In fact, overweight on large caps, selectively neutral weighted on mid caps. Small caps are far too difficult to decide within right now, and the risk reward doesn't make sense for a larger group of the pack. Of course, there are isolated opportunities, but exercise a very high degree of discretion. At the same time, now is definitely not a time to hoard cash. If you want to divest away from equities, it is a very smart thing to look beyond equity and start playing fixed income and commodities to some extent, and do not let your cash remain ideal, because there are opportunities beyond equity as well.
Okay, okay. Nirav, then let's talk about earnings, because now that we are almost at the end of the earnings season, where are you finding value and for a good run up going ahead in terms of sector specific, and of course anything that you believe that investors should remain on the sidelines?
So, like I highlighted at the start of the conversation, we are towards the fag end of the downgrade cycle. Right, the past couple of quarters witnessed iterative downgrades across the board. In fact, troubling global macros, domestic geopolitics were bearing very heavy on equities and earning potential largely. Also, the domestic earnings were not reviving. As per expectations. However, a lot of that has already been aggressively priced in. From here on, we believe that India's superior positioning, especially within the emerging markets pack and also the rest of world in the face of the new tariff regime, that the US has unveiled, the more favorable positioning of India puts it in a very good spot. At the same time, the macroeconomic fundamentals are very strong. It continues to remain resilient. And having said that, while we are talking about the rest of the world suffering from yield hardening and inflation going out of control, domestic inflation is very well under control. We have a firm handle on it. In fact, as we speak, there is a wide held anticipation and expectation of successive rate cuts to come in, creating a more easier environment for liquidity in the system, right? The central bank has been effectively ensuring that systemic liquidity remains supportive of growth, especially through their open market operations. So all indicators are pointing towards a revival in earnings. A lot of it will be boosted through private capex cycle. Finally, hopefully, showing early signs of life. There was an issue around bank margins, but most of that is also ebbing. The entire virtuous cycle of credit offtake is yet to kick off. So better days are still ahead of us. I feel the worst is behind us as we speak. So going ahead, earnings, the outlook for earnings also reported. While the current set of earnings were a mixed bag, the outlook largely seems to be positive. In fact, even though I call the current set of earnings a mixed bag, if you look at the Nifty 100 pack, Bernstein recently reported that the beat ratio is at 51%, which is a very good measure from if you were to look at it from a near term historical perspective, right? So many companies have been able to beat estimates, and that should be a very strong signal for hope going ahead. There are several sectors that we are looking at favorably right now. So communications is one at the top of the list. Apart from that, we believe there are several opportunities selectively in the pharma space, especially those engaging in CDMO and contract manufacturing. So selectively in the pharma segment. Along with that, we believe there are a good set of opportunities emerging on the industrials side as well. As public capex starts picking pace, that should be an incremental tailwind to several players under the industrial segment as well. So these are a few sectors that we're looking at positively. From here on, we expect an earning upgrade to come through in some of these segments that I just spoke about.
Okay, okay. All right, all of this to keep in mind, but with that, we have to let you go, Nirav. Thank you so much for your time.
Likewise. Thank you.
All right, let's take a quick check of the markets. Well, we are in a good positive territory. We can see the extension of the buying, and the sensex is up about like 500 points, and Nifty is also above that 24,750 mark. So yes, a good day for the markets so far. India VIX has also cooled off, which indicates that the unease in the investors and the anxiety in the investors' mind has taken a little bit of a backseat at this point of time. Some of the sectors which is doing well: Nifty IT soaring in the trade with about 1% gains, Nifty Realty Index with about 0.5% gain, and Nifty Media Index also extending the rally from yesterday with about 0.8% gains. Nifty Bank also continues to do well. Nifty Auto also set in the positive lane. Only the sectoral laggard today continues to be Nifty Pharma Index with about 0.6% cut. On the other hand, if you look at the broad-based, it's a broad-based buying markets, and we can see the mid-cap and small-cap indices have also taken the chin up, and and they're exhibiting gains of about 0.3% or so. But yes, with that, we've come to an end of this edition of the Opening Bell. Do connect us at 3:30 p.m. for closing. We will be discussing about how the market is developed and what the stocks were in focus. Until then, signing off.